The number one mistake most people make while choosing an ETF is it can be costly and detrimental for your future returns. If you want to avoid zero returns for the next 10 years, exchange traded funds or ETFs is a great segue for people who wants to invest in stock market, who does not have the time or the interest to analyze stocks. They are great products out there, and ETFs is definitely one of the best instruments. But you should be careful while choosing ETFs. The most common mistake people do when choosing ETFs is driven by recency bias. Recency bias is a behavioral bias which makes people to look at the recent events or recent performance and then choose ETFs based on those performance. People look at last 1 year performance. For example, you see on the screen the best performing ETFs out there: Fidelity Blue Chip Growth Fund, which returned 58%, Wisdom Tree US Quality Growth, which returned 56%, Invesco QQQ Trust Series, which mimics Nasdaq 100, has returned 55%. These are stellar returns. It's not normal, right? It's driven by the AI boom and the so-called Magnificent Seven, right? Whatever the reason be, people will choose these ETFs and put lump sum money in those ETFs, thinking that extrapolating the same growth would happen in the near-term future. But mean reversion is the ultimate truth in the stock market. The recency bias has to be overcome, and mean reversion, what do I mean by that is it tends to revert to the averages over long periods of time, whether it is stocks or ETFs. So let me vindicate with two examples. First one is Japanese bull market in 1989 that peaked in 1989. The Nikkei index, the value that Nikkei index had in 1989 was not again touched or retraced back until 2024. So there was a significant 25-30 year underperformance or zero performance from an index like the second largest economy, Japanese Nikkei index. Same has happened with Nasdaq tech market, the tech bull market, which peaked in year 2000. It never saw that value again until 2014. There was a 14-year zero performance from Nasdaq index. So this could happen to any index. It could happen to S&P from here on probably in the next 10 years, because S&P is heavily concentrated by tech, 30-40%, so-called Magnificent Seven. So how do you overcome this problem? The solution is, there are two solutions. The first one is diversification. The second one is dollar cost averaging. Now, diversification means I'm not saying you go and have 7 or 8 ETFs, because ETF or exchange traded fund itself is a diversified asset class. Each ETF itself comprises 30-40 stocks. So you don't need to have 7 or 8 of them. All you need to do is have one, or in addition to one, have another couple of more. Maybe 2 or 3 ETFs would suffice. For example, if you have an S&P 500 ETF or a Nasdaq 100 ETF, then it's a good idea to look at maybe a small cap ETF like an IWM, or an emerging market MSCI ETF like an MSCI India or MSCI China. Now this will give you a global diversification, avoids country risk, and eliminates or negates the impact of mean reversion in the near future. Now, if you don't really want to diversify, then the idea is to dollar cost average. You look at dollar cost averaging every quarter or every month consistently for the next 2 to 3 years, so that you don't get impacted by the price increase or decrease. So you average up or down automatically. So diversification is a great idea, even if you want to have just one ETF in your portfolio. But if you want to have 2 or 3, look at the underperforming ETF in the last 3 to 5 years. Look at IWM, which has underperformed the small cap index, which is mimicking the Russell 2000, which primarily comprises the banks, commercials, and real estate and consumer cyclicals. They are direct beneficiary of the reversing interest rates by Fed. Now, a strong correlation also exists between emerging markets and the interest rates, because once dollar starts reversing along with the interest rates, the EM basket is going to outperform. So look at an MSCI India or MSCI China, which has secular tailwinds even in terms of growth, GDP growth in the next 1 decade. So having a 2 or 3 ETFs is a good idea to stay invested for long periods of time, so that you don't get impacted by mean reversion or recency bias. Trust this was helpful. Signing off, Sandeep Anand.